Hi, everybody. Thank you all for joining us today for which type of 1031 exchange is right for me. We're going to get started here in about 3 minutes at 3:05, just to give everyone a few extra minutes to get logged on. So just hang tight and we'll get started shortly. All right. Thank you all for joining us. We are going to get started. And I just wanted to note that this webinar is being recorded, so we will send it to you as soon as the presentation is over. Also, if you do have any questions, please type them into the chat box on the right-hand side of your screen, and Teresa will answer those questions for you afterwards. So as mentioned, today, Teresa is going to discuss which type of 1031 exchange is right for you. All right, next slide, Teresa. All right, your presenter today is Teresa Noer. She's been with the company for, God, 100 years now, I would say. Just kidding, but for a very long time, over 10 years. She is a certified exchange specialist, which is just an extra designation that 1031 exchange qualified intermediaries can get, but aren't required to have. So it makes her just a little bit more of an expert than maybe other intermediaries are. That's her contact information. And then just a little bit about Midland 1031. We are not only 1031 exchange qualified intermediaries, but we are also self-directed IRA administrators, meaning that we allow our clients to invest in alternative assets in their retirement accounts tax-free. We have three offices. Our main offices are Fort Myers, Florida, Chicago, Illinois, and also Sioux Falls, South Dakota. That's where our trust office is. Um, we have two certified exchange specialists on staff. Not only is Teresa a CES, but so is the owner, Dave Owens. We are bonded and insured. We offer personalized service, and this is for educational purposes only. We do not give legal or tax or investment advice. We're not CPAs and we're not tax advisors. So if you do have any questions pertaining to capital gains or anything regarding your tax situation, we are not the people to ask. So, all right, Teresa, I'm going to let you take it away and tell us which 1031 exchange is right for us.
All right. Well, good afternoon, everyone. Thank you so much for joining us today. I do want to offer one clarification. I have not been with the company for 100 years. It's been more like 15-ish. I'm sure some people that have to deal with me on a day-to-day basis might say it feels like 100 years. But so anyway, thank you all for being here today. We are here basically to accomplish hopefully four things. One, we're going to discuss how you can defer the taxes on the sale of investment or business use property using just a straightforward standard exchange, okay? Which is probably what most of you are familiar with. Then we're going to talk about how someone could complete an exchange where they buy first and then sell. We're going to talk about how you could use a deferred or standard exchange and reverse exchange together in order to maximize tax deferral. And then we're going to talk about how someone could incorporate improvements to the replacement property and have those improvements sheltered in the exchange. So it's an opportunity just to see what options are available to people considering doing an exchange. And some may be surprised to see that there's more than one way to defer the taxes through an exchange. So we're going to take a look at a couple of different scenarios. So the first one is when selling a piece of property that has significant gains, is there any way to avoid having to pay tax on those gains? That's usually the question that comes up. Or more often, people will call in and say, I'm selling property that's got significant gains and I don't want to pay the government any more in taxes than I absolutely have to. What can I do? Well, there is an opportunity. Section 1031 of the tax code says, yes, there is an opportunity for you to defer those taxes through a 1031 exchange. There are some rules that have to be followed in order to ensure that you get to defer those taxes, which we're going to discuss here. But basically, 1031 is, to me, a gift within the tax code because it is a tax deferral strategy that allows someone the opportunity to defer the taxes on the sale of investment or business use property, provided that they follow these rules and that they buy more investment or business use property of equal or greater value. That is technically what a 1031 is. You're selling investment or business use property and you're buying more investment or business use property of equal or greater value. If you do that, you get to defer the taxes that would have otherwise applied to the transaction. So the first rule is, in order for something to qualify or a property to qualify for 1031, it has to be investment for investment or business use. In other words, no primary homes, no second homes. If you've got vacation rentals that you might use a little bit here and there, but you rent it out primarily, there's an opportunity to possibly do an exchange on that. We'd have to talk to you a little bit more and find out specifically how much you're using that property to see if it would qualify. So rental properties are what we are looking for, unless it's vacant land, in order for it to qualify for the exchange. This applies to what you're selling and what you are ultimately purchasing. They both have to be treated the same way. The second rule is that you have to use a qualified intermediary, which is, as Brenda mentioned earlier, what our role is. The qualified intermediary is there to facilitate the exchange, and that is their sole primary function. They're not the realtor, they are not the attorney, title agent, nothing. Our role as the QI is simply to document the exchange, and that's it. You do have to have one in place though. So if your intention is to complete an exchange, you need to make sure that you have a qualified intermediary working on your behalf prior to closing on the sale of your property. If you reach out to someone like us after closing has already taken place, the opportunity to do the exchange is lost. So if you remember nothing else about exchanges, it's that you need to have a QI in place before closing. Now, in order to ensure that you defer all those taxes, you do have to purchase property that is at least equal to or greater than the value of the property you are selling. More specifically, it needs to be equal to or greater than what's known as the net selling price of the relinquished property, which is technically the contract sales price minus your standard costs of closing, such as realtor commissions, title fees, the exchange fee. Those items, and they're usually things that you would find in a cash transaction. If you're wondering what types of closing costs are typical standard costs of closing, think about what you would typically see in a cash transaction. Those closing costs are pretty safe bets on being exchange expenses. You can subtract that from the contract sales price to get a more specific number of what you're trying to match or exceed in the exchange. You can buy more than one replacement property. So it's not a one-for-one situation. You could sell one property and perhaps buy two properties that equal your net selling price. Or you could buy one property. The goal is to match value for value. So however you want to structure that is entirely up to you. On the flip side, you could possibly sell multiple relinquished properties and pool those funds into one larger replacement property, which we will talk about here in a little bit in terms of strategy, because sometimes the timing does not always work in your favor. Bringing us to the final 2 points, the timing. You unfortunately do not have an indefinite amount of time to complete the exchange. You have 180 days from closing on the sale of your relinquished property to close on all intended purchases. Within the first 45 days of that 180-day period, you will need to formally identify what you are considering purchasing as your replacement property in the exchange. Only what's identified by day 45 will qualify. So with the way the current market is right now, I think the further you can get in the process in that 45-day period, the better. So all that's truly required of you at this point is to identify the property itself. We would provide a form for you to fill out, and then you would simply provide the address and whatever the sales price is. However, as I mentioned, only what's identified by day 45 will qualify. So once you get past day 45, you will not be able to make any sort of substitutions or revisions to your list of identified properties. So the further you can get in the process in that 45-day period, the better it will be for you and the more assurance that you will have that you will actually be able to complete the exchange. So that is a standard exchange in a nutshell. It's you're selling a property, you're buying the new replacement property within the allowed period of time, the 180 days, you're identifying it within the first 45 days. Okay. For those of you that are familiar with exchanges, hopefully this information is sounding familiar somewhat, and it's probably what you're used to in terms of whether you do exchanges yourselves or you're working with clients who do exchanges. But now let's go into something a little bit different that's not so common, but we're seeing more and more, especially right now. Is it possible to buy first, then sell, and utilize the benefits of a 1031 exchange? Well, Revenue Procedure 2000-37 says, yes, you can do that. It's known as a reverse exchange. So in 2000, the IRS issued Revenue Procedure 2000-37, which basically gave provisions for taxpayers who weren't able to do a standard deferred exchange where they would sell first and then purchase. They found themselves in a situation where they found the replacement property that they wanted to purchase, but they didn't even have a contract for their current relinquished property yet. So the reverse exchange allows a taxpayer to buy first and then sell. Now, our role or function in this type of exchange is twofold. Up front, when it comes time to do the new purchase, we would establish an entity known as an exchange accommodation title holder, or EAT. This EAT or EAT is going to take title to one of the properties, and it's usually going to be the new replacement property, not the relinquished property. This entity will take title to that property, and it will be held in that entity until you close on the sale of your existing relinquished property. So here's what happens. The taxpayer exchanger has found the ideal replacement property before even having a buyer for their relinquished property. They don't want to risk selling a good property for something unknown. Okay, so we're encountering a lot of clients right now in that situation where they want to make sure that they can lock in the replacement property, or at least know what they're going to purchase before they even think about selling the relinquished property and closing on that. Because they know once they close on the sale, if they were to close on the sale first, the clock starts ticking. And they don't want that pressure. Some of them don't want the pressure of the 45-day identification period. So unfortunately, a theme for a lot of clients right now is it's not so much finding suitable replacement properties, but more so finding properties that are so attractive that there are multiple offers on the table. And by doing a reverse exchange, you've already locked in the replacement property, and it takes a little bit of pressure off of the taxpayer. And also, the reverse exchange is an option when the seller of the replacement property doesn't want to wait. I have seen some clients able to negotiate the purchase contract to be contingent on the relinquished property sale closing. But those instances are few and far between. Most sellers, they want to sell their property, close, and move on. So this is where the reverse exchange will typically come in. It's out of necessity. So those of you on this call that are in the real estate industry, and perhaps you are used to seeing just standard verbiage within the real estate contracts that allow for someone to complete an exchange. That's great if the client is looking to do a standard exchange, but for a reverse exchange, it is very important that the taxpayer have specific language added to the contract allowing for the assignment to an exchange accommodation title holder. We can provide that verbiage, but I want to stress that the standard 1031 verbiage that you will find in some contracts is not sufficient to cover the assignment to an exchange accommodation title holder. So first thing is you make sure that there's language in the purchase contract allowing for the assignment to the EAT. Next, we would establish the title holder entity that would take title to the property. And for us, it is very, very important to confirm who is on title to the relinquished property, because that will determine how many single member LLCs are established. For example, if I'm doing a reverse exchange and I'm the only one on title to the relinquished property, then one LLC is established. However, if I held title with my husband, then we would need two LLCs, because there's a single member LLC established per taxpayer completing the reverse exchange. So having that information is critical to ensure that we set the reverse exchange up correctly. So once that's done, we would provide closing instructions to the title agent or attorney handling the closing, advising them of how title is going to be taken. So again, a separate entity is going to be the buyer and title holder of this new property. So we need to make sure that the closing agent or attorney is aware of this and that they have all of the information they would need to ensure that they can prepare their documents accordingly. For purposes of signing closing documents and signing any documents actually related to the purchase and the property, we would designate the exchanger as a special agent of the LLC. They're going to be an authorized signer, and they're going to sign all the documents and provide all the funding for this purchase. We are simply acting as a title holder. So one thing that I want to stress is because we do not have funds from the sale of the relinquished property, the taxpayer needs to arrange for the funding of the new purchase, either with cash, with financing, or perhaps a combination of the two, which we will talk about here in a couple minutes. But I do want to mention that in terms of the logistics, we're simply coming in to act as the title holder. There's a little bit more responsibility on the taxpayer doing the reverse exchange to make sure that they have all the necessary funds in place to actually close this purchase. So some common questions that come up. One is, I have an LLC that I set up before. Can I just use that one? Unfortunately, no. The LLC must be a new LLC that we establish, and the purpose of the LLC is to facilitate the reverse exchange. So it needs to be established by us, owned by us initially, and the operating agreement that is prepared will also tie it back to the reverse exchange and the purpose of this entity. So unfortunately, if you have an LLC that you've already set up that you haven't used yet, we wouldn't be able to use that for the reverse exchange. Follow-up question is sometimes, well, why does the LLC even need to be set up? Why can't we just take title to the new property? And that's a great question and a fair question. Since things are basically happening in reverse order, there needs to be a title holder in place while you try to find a buyer for your relinquished property. If you were to take title to the new property and you have not yet sold your old property, you would ultimately have ownership of the old and new properties at the same time. And at no point would there be an exchange taking place. The exchange technically takes place when you sell your old relinquished property and you receive and acquire the new replacement property from the title holder. All you're doing up front in a reverse exchange is establishing this, what's known as a parking arrangement. You're securing the replacement property and parking it with this title holder until you close on the sale of your existing property. But if you were to take title to the new property directly in your name, then there's no exchange taking place at any point in time. You basically bought a new property, and when you eventually sell the other one, that's it. That's all you're doing is you're selling it. So it is necessary to have this LLC set up to take title to the new property. So one of the first questions that we ask clients who are considering a reverse exchange is, how are you going to fund the purchase? Because remember, since the sale hasn't closed yet, we won't have any proceeds to use towards the acquisition. And no, we unfortunately do not front the money for the purchase, which is a valid question too, by the way. Sometimes people think, well, you're going to be the title holder. Are you also going to provide the funding? No. So you'll either have to provide the cash, which certainly makes things so much easier in terms of completing the exchange, or the taxpayer will have to get some sort of financing, which I will be honest, can sometimes create some challenges. And the reason is the financing would have to be in the name of the LLC that's established for the purpose of the exchange, but the taxpayer is going to be the one guaranteeing payment of the debt. It's not impossible to do this, but it's definitely challenging at times to get this type of financing. So what if the lender, the bank, will not allow the taxpayer to put the loan in the name of the LLC? There is one other opportunity, and they can potentially park the relinquished property, provided that it is owned outright by the taxpayer, and it would require that the exchanger or taxpayer deeds the old property to the technically the title holder entity, and that would allow them to purchase the new property in their names personally. This, my friends, is known as a forward reverse. Okay, so because you are parking the relinquished property, you haven't sold it yet, but you're going to park the relinquished property in the title holder entity. And then you are buying the replacement property in your names directly. I'm going to be honest, we don't see too many of these specific types of reverse exchanges. It is cleaner and easier to park the new replacement property. However, it is at least good to know that this is an option, because sometimes this may be the only way that a taxpayer can make it work. So there is that last resort of parking the relinquished property if push came to shove. Now, after closing on the purchase of the new property, the taxpayer would have 180 days to close on the sale of the relinquished property. Okay, so what you're doing with this parking arrangement is you're buying yourself 180 days to close on the sale of your relinquished property. If there are multiple relinquished properties that you are considering selling, then you would have to formally identify those properties within 45 days of closing on the new purchase. So, and again, if somebody is the lucky taxpayer that is doing the forward reverse where they've parked their relinquished property, then they would need to identify the replacement property within 45 days of parking the relinquished property. So while the property is parked, the taxpayer is going to be able to lease the property from the title holder and basically treat it as their own. So they're going to be responsible for any expenses associated with the property. They can rent it out and collect rental income off of it while it's parked by with the title holder. So for all intents and purposes, they will get, it's as if they own that property themselves. They just don't have title to the property yet. They will eventually own it, but while it is parked, they get to treat it as though they already own it. So once they're under contract to sell their existing investment property, the relinquished property, they would forward us a copy of the contract for that. And this part of the transaction is no different from a standard exchange. We would prepare the same exchange documentation just like we would in a standard deferred exchange. We would provide closing instructions to the title agent or attorney handling the closing. And then the sale proceeds would come to us. And what would typically happen is they'll be deposited in escrow on behalf of the taxpayer. And then this is technically when the exchange is completed. So with respect to the proceeds that we received, we would turn right back around and we would either disperse those funds to the lender if there was a lender involved, or we would disperse them directly to the taxpayer exchanger, because what they did was provide the funding upfront for the new purchase. So they technically loaned the title holder the funds to make the new purchase. And what we're doing right now is we are repaying that taxpayer for any funds that they've paid out of pocket, and or paying down the loan that was secured to purchase the new property. Sometimes it's a combination of the two. At that point in time, we would also transfer the new property to the taxpayer by doing an LLC membership assignment. That is typically what we will do. So the deed would stay in the name of the LLC that was established for the purpose of the reverse exchange, but the owner of the LLC would be the taxpayer now. All corporate records, all documentation would be recorded to show that the new owner of the LLC is the taxpayer, and we have zero involvement in the LLC moving forward. Some may request to have a deed prepared, which they would, if they're willing to get an attorney to prepare the deed, to deed it out of the LLC and into the taxpayer's name, we can certainly facilitate that and do that. However, it may not be possible if there's still a loan on the property, and they also will want to make sure that everything that was put in place in the name of the LLC will remain in effect even after they deed the property out of the LLC and into the taxpayer's name directly. So it's important to kind of keep that in mind. It seems like for some, it seems like such a trivial thing that, well, I mean, I don't need this LLC anymore. Why do I need to keep it? I hear you, but just make sure that you check with all proper parties to make sure that you don't inadvertently ruin whatever insurance coverage you have or title insurance. You want to make sure that everything will remain in effect no matter what you do, whatever direction you go. So there are a few things to keep in mind, and with respect to reverse exchanges specifically. Insurance coverage. Don't wait till the last minute to get insurance, because they need to understand what's going on, just like the lender does, which is bullet point number 3 in terms of financing issues. This is not something that you can do at the last minute. You need to get all your ducks in a row and get everyone involved on the same page with respect to what's happening. Because the biggest challenge usually is the financing, and the second biggest challenge is going to be the insurance coverage, because we will require that there is insurance on the property because of the fact that we're going to be the title holder for a period of time. So we need to make sure that there's insurance coverage in place on that property prior to closing or on the day of closing. The contract must be assignable. We talked about that earlier. Make sure that that verbiage is in the contract so that you don't have any unexpected surprises when it comes time to try and close and somebody says, well, wait a second, who is this LLC? That they're nowhere referenced on the contract. There was nothing referencing a reverse exchange at any point in time. Those little steps that you can take in the beginning, if this is something you're contemplating, will save you a lot of headache on the back end for sure. And then LLC maintenance is going to be one of those ongoing responsibilities that the taxpayer will have if they decide to keep the LLC once we've assigned it back to them. That's just something they're going to have to keep in mind, that you're going to have to do the annual filing and renew that LLC every year. Some don't mind, but if you don't want that responsibility, then you can investigate doing the deed out of the LLC and into the taxpayer's name. So just a few things to keep in mind with respect to the reverse exchange. It's all doable. It's just making sure that you plan properly and don't wait till the last minute to get the process started. Okay, so let's look at another scenario. Okay, Dave Owens is selling an investment property for $600,000 and is scheduled to close on April 15th. He's already gone under contract for his replacement property for $1 million and is scheduled to close on April 30th. He has another property he wants to sell in this exchange for approximately $400,000, but it's not even under contract yet. He wants to know if there's some way of including that second sale into the exchange, because he's looking at the numbers and he's thinking, well, okay, I know that the $1 million property is going to more than equalize that $600,000 sale. But if I could also include that $400,000 sale into this exchange, I get to maximize my tax deferral, right? Because the total sales prices between the two is $1 million, and he's buying $1 million replacement property. So he wants to know, is there some way that he could incorporate that second sale that will obviously happen after closing on the new purchase? Does he have any options available to him? Well, yeah. He may be able to structure a combination of a reverse exchange and a forward, standard, delayed exchange, however you want to call it. Okay, it's a combo. I like to call it a little bit of a hybrid. It's a standard exchange and a reverse exchange together. So let's walk through this. There are two phases in this situation. Phase one is the standard or delayed exchange. So based on the facts that were outlined, he's got his sale of his $600,000 sale is closing before the new purchase. So he sets up an exchange, a standard exchange on behalf of that $600,000 property. We do what we do. We send the instructions to the title company, get the exchange set up, and proceeds come to us. Okay. So now we're holding the proceeds from his $600,000 sale. And he needs to basically allocate a percentage of the new purchase on behalf of the standard exchange. Because he's basically going to tell us, okay, let's say there weren't any closing costs or anything, that we netted $600,000. So now he's saying, I have the replacement property picked out, and I'm going to apply $600,000 of proceeds towards this $1 million purchase, which equates to 60% interest in the new property. He's buying the whole thing. He's going to buy the whole property. He's buying 100% of it. However, he is allocating or identifying 60% of the total value to the standard exchange, because that's enough to equalize the $600,000 exchange. Phase two is where the reverse exchange comes in. So he's earmarked 60% of the new property to the standard exchange. That leaves the remaining 40% interest in the new property to be earmarked for a future sale. And what happens when somebody needs to close on the purchase before they've closed on the sale of the relinquished property? They set up a reverse exchange. So what happens is we're going to set up a reverse exchange on behalf of 40% interest in the new purchase. Then from closing on the new purchase, Dave would have to formally identify what he is considering selling to equalize that 40% interest, or $400,000 worth of replacement property. And he would have 180 days from closing on the new purchase to close on the sale of his relinquished property, the second relinquished property. So at closing for the new purchase, here's what's going to happen. The deed's going to show two owners. It's going to show Dave Owens as to 60% undivided interest on behalf of the standard exchange that he will have completed at this point. And then the remaining 40% undivided interest is going to be titled in the name of the Reverse Exchange LLC that we established for purposes of completing the reverse exchange. So there are two owners on the deed. So now when it comes time to fund that purchase, the replacement property, on behalf of the standard exchange, we would wire the $600,000 that we're holding in escrow on behalf of phase one. And then Dave Owens would loan the Reverse Exchange LLC the remaining funds to cover the 40% interest in the property. That's part of the reverse exchange. Because remember, he hasn't yet closed on the sale of the second property that he hopes to sell for $400,000. But we're closing on a $1 million property today. Midland 1031 only has $600,000 to fund that new purchase. So Dave's got to come in with the remaining $400,000. So phase one, the standard exchange is completed. When we close on the purchase of the new property, that's done. That standard exchange is done. Phase two, the reverse exchange, when we close on that purchase of the replacement property, where the Reverse Exchange LLC takes title to its 40% interest, that clock starts ticking, meaning from the date of closing on the new purchase, Dave has 180 days to close on the second sale. I know this is probably really, really confusing or dizzying almost. I just want you to remember that it is possible to get, I don't want to say creative, But where there's a will, there's a way. And so what we're encountering right now, especially, is that I think you remember me saying earlier, time is not always on the taxpayer side. You know, the best case scenario is all your sales close first and then you close on the new purchase and this all gets wrapped up in the 180 days. Sometimes life just doesn't work out that way. But if you want to maximize your tax deferral, there are ways to utilize more than one type of exchange to ensure that you defer as much in taxes as possible. So just know that's the point of this particular scenario, is that while it doesn't happen very often, it does happen, and we've seen it more so recently than we ever have in years past, because people want to be able to take full advantage of the exchange, and sometimes that means doing a hybrid like this. But it is available to you, and not many people realize that. So just something to keep in mind. Final scenario is, what if I identify property that is significantly less in value than my net selling price, but it needs a lot of work? Could I include the cost of the improvements into the exchange? Short answer is yes, but it will require some planning. It will require some organization on behalf of the taxpayer. They need to know this ahead of time, or kind of have an idea of what they plan on doing. This is an improvement exchange. These are ideal for those fixer-upper properties that need significant work. What typically happens is the taxpayer will close on their sale of the relinquished property, and then eventually they will purchase they'll find a replacement property, and they want to use the excess proceeds to make improvements to that property. Unfortunately, you can't just buy the property in your name and then have the qualified intermediary disperse the funds for the improvements. What has to happen is there needs to be, it's very similar to a reverse exchange, basically. So you need to know, by the time you identify the replacement property, if you plan on incorporating improvements, you have to identify those improvements with the property as well. And you'll have to list those out, because you want to include the value of those improvements as part of the replacement property value. So for example, if you found a property that was $200,000 that needed $50,000 worth of work, you would set up an improvement exchange so that the value of the replacement property that you eventually receive is $250,000 worth. So they're set up very similar to a reverse exchange. What would happen is we would set up one of those title holder entities to take title to the replacement property, and we'd basically hold it for you while the improvements are being completed. While we hold title to that replacement property, the taxpayer is going to be the project manager, so to speak. So everything is going to come and be directed by the taxpayer. We would not issue payments to vendors or contractors or do anything without first having the authorization from the taxpayer. So what would typically happen is they would work with whoever they're going to work with. They receive an estimate or an invoice. They pass it on to us to issue the payment directly to the third-party vendor or contractor, or whoever needs to be paid. But everything's basically being driven and directed by the taxpayer. However, while the work's being done, they don't own the property. We have it parked in that title holder entity. The taxpayer only has what's left of the 180-day period to complete the identified improvements to the property. Only work that is completed by day 180 will be sheltered by the exchange. At the end of the exchange period, when we assign the LLC membership interest to the taxpayer, because that LLC owns this property plus the improvements that are in place, the taxpayer is now getting the replacement property at whatever the value is as of the date of assignment, which would be the purchase price plus the cost of the improvements that were added to the property. This type of exchange only makes sense if, number one, you're doing significant improvements to the property. Number two, they do have to be actual improvements, such as something like putting a new roof on, or gutting and redoing the bathrooms. This is not something that you would use for furnishing the place, because that's personal property. Putting in new appliances, that is also personal property that you could not use exchange funds to pay for. So when somebody starts asking us, can I use some of the money to do improvements to the property? We try to dig as deep as possible to figure out, what are you looking to do, and will this even make sense? If it does, then we walk them through the process of, well, here's the deal. We're going to have to take title to that property and basically hold it for you while this work is being completed. And keep in mind that you only have what's left of the 180 days to complete this work. If that's all doable, then this exchange might be truly beneficial to the taxpayer. But if they're only looking at doing minimal improvements to the property, it may not be worth the cost and effort that comes with setting this up. Every situation is different, so we try and do our best to provide as much information as possible, get as much information as possible, so that we can lay out what the options are for the taxpayer. A few things to keep in mind with this one. Again, very similar with the reverse exchanges. Insurance, because remember, title is going to go into the name of the title holder entity that we set up. It's not going to go into the taxpayer's name. So we want to make sure that there's insurance in place on the property. Financing, again, that might be a challenge, because the lender needs to understand what's happening and why there's a title holder in place, and who is the guarantor of the debt. Timing. It depends on what kind of work the taxpayer is looking to do, but ideally, a picture perfect improvement exchange would look something like this. You close on your sale. You already know ahead of time you want to do the improvement exchange. You already have the replacement property under contract and set to close pretty quickly after closing on your sale. You have the improvement exchange already set up so that you get to make the most of that 180-day period. If you identify a property and then, say, 120 days in, for example, you decide to pull the trigger on the property and do the improvements on it that you identified, that only leaves you what's left, which, 60 days to get the work done? Is that possible? I don't know. Depends on the work that you're looking to have completed. So these are just some things to keep in the back of your mind. Will time allow you to do what you identified as the improvements to the property? And then permitting. That's something that is outside of the taxpayer's control. That's outside of a lot of people's control. But keep in mind that these deadlines for completing the exchanges are hard deadlines. Your 180th day is the deadline. The only time there is ever an extension or exception to the deadline is in the case of a natural disaster. And there are formal notices that are issued that outlines who are the affected taxpayers and what is afforded to them. So if permitting doesn't come through in order to allow you to start whatever work you're going to be doing, then that could put a wrinkle in the exchange. So the more you can do up front in terms of planning, in terms of asking questions and figuring out what's feasible in terms of improvements, the better. I had a client who planned on doing a ton of improvements to the replacement property, a lot that far exceeded what he needed to do in order to equalize his exchange. So he went back through and he kind of cherry picked what he knew would easily be completed within the 180-day period and was valued at enough of a value to help him equalize his exchange. So if you know what's required and you get all your ducks in a row up front, it can be a very seamless process. but it definitely needs to make sense. It has to be the right situation. But again, the purpose of this scenario or showing this to you is that it is possible to incorporate improvements to the property as part of your exchange. What what you can't do is take title to the property, buy it and take title to the property, and then ask to incorporate improvements after the fact. Once you have ownership of the property, you cannot use exchange proceeds to make improvements to it. You'd have to set up an improvement exchange. Okay, I know that that was a ton of information, probably more than you were expecting. Maybe not. So I hope that everyone on the call today at least maybe learned a little nugget of something about 1031s that they didn't know before today. But I'd be happy to see if I can answer any questions that anyone may have, if there are any questions.
Yes, it looks like we do have a couple questions. If we, I'm sorry if you went over it already, but I'm going to read them anyway.
Okay.
So I have a rental property which both my sibling and I own. Could I do a 1031 exchange on my own share?
You could, as long as you're both on the deed to the property as tenants in common, for example, then you could elect to do an exchange on your share and your sibling could just cash out and take the proceeds. If you happen to own that property in an LLC, for example, that you both own, then you would not have the opportunity to just elect to do an exchange on your share of the sale. But if you're both on the deed, you can do an exchange on your own interest and your sibling can cash out.
All right, perfect. Thank you. Are costs higher for a reverse 1031, LLCs, title company, and other related fees?
So I can't speak to the title company fees, but I can say that yes, they are reverse exchange fees are definitely higher than your standard deferred exchange. Just to give a frame of reference, standard exchanges can run anywhere from $795 to $995, depending on the complexity of the transaction. Reverse exchanges and improvement exchanges together, any type of reverse or improvement exchange, starts at $4,900. And again, depending on how many relinquished and or replacement properties we have involved or how many taxpayers are involved, that fee could increase. So yes, the costs are higher. So anything you can do, here's what I would say, and I tell this to clients all the time that call in asking about reverse exchanges if that's an option. My first comment is usually whatever you can do to avoid having to do that, I would strongly encourage you to do that. Whether it's if you can push the purchase closing back to happen after closing on the sale, even if it's a day or two after the sale, whatever you can do to work it out to where you just do a standard straightforward exchange, I would certainly encourage that. But there are some clients that find themselves in a predicament where that's just not an option. And what they will be saving in taxes by doing a reverse exchange still significantly outweighs whatever fees are involved. But if there is an option, if there is some flexibility, do whatever you can to set it up to where it's a standard delayed exchange.
All right, that's good advice. Does anyone have any other questions? We'll give it maybe just one more minute. You could type it in now to the chat box or the questions box. Um, but if not, that will conclude our presentation for today. As you can see, Teresa's information is on the screen, and then you will receive this recording afterwards. And as always, if you need anything, you're welcome to reach out to us and we'll help you out. So, what do you think?
Thanks,
All right.
everybody. Appreciate it.
All right. Thank you all. Have a good day.